Hey everyone. Okay, today we talk about bankroll management. Bankroll management is kind of the thing that separates a lot of people who are trying to be pros and aspiring pros in day trading from the actual people who are pros. And this is quite a staggering difference when we actually look at how many people go from learning technical analysis and actually turning themselves into pros, right? And you have kind of two different worlds in day trading. You have the theory and practice of actually doing it every single day. And then you have the technical analysis, right? So everybody here knows the technical analysis part of that. That's all fantastic. That's all great. We all know what we're doing there. But the harder part of day trading is actually getting to that point where you can profitably trade on a regular basis. So bankroll management becomes a huge part of your world in day trading. Bankroll management actually becomes one of the things that separates people from being professionals and non-professionals. This is quite similar to bankroll management in poker. A lot of ex-poker players are now day traders, and a lot of day traders use these same principles. So we are going to talk about some different bankroll management techniques and some different practices that I like to employ, and some things that will help you guys understand how to do this long-term as a career and kind of that missing piece for a lot of people. So I am going to bring over my Binance screen here, and we are going to look at some live trading here. I have put $500 in my account here, and I'm deciding to trade futures here. Let's say I have $500 in my account. Okay, so let's take a nice jolly number, and that's why we use $500, just because I think this is a starting number that a lot of people who are trying to day trade start with, or it's a good practice number to see exactly what you can do, right? So this is kind of a good starting point for us today. Start to dissect and develop a bit of a better understanding of bankroll management. Okay, so the first thing we need to do is talk about account size. All right, so your account size in day trading is going to play a big part in what you are actually trading. And if you're thinking a big part in terms of, oh, if I have more, it changes the way I trade, that's absolutely incorrect. Okay, the more you have in your bank account and the more you have in your bankroll, it doesn't affect anything about proper procedural techniques, right? Proper procedure when we talk about bankroll management. Unless you guys are trading, like here's an example here. This person has 14 Bitcoin in this trade. This is not a lot, okay? You see, if we are on 100x leverage and we simply slide our $500 over, we have 6 Bitcoin here, right? So let's look at these books for a minute. Not that I ever study the books, but I want to show you guys as an example. This person here has 27 Bitcoin. This is nothing but a $2,500 trade. That's max leveraged, so forth and so forth. Now, maybe let's go and do this. Check the sell side, see if there's anything really notable. No, there's not. Okay, let's change the amount here. So you have 21 Bitcoin here. That's not enough to make any difference in the market. $175,000 is nothing. That's pocket change for people. This 52 Bitcoin, wherever it was there, right here, 400,000, that's nothing. Until you start seeing orders in the 500 plus Bitcoin range. These are the things that aren't affecting the markets, okay? So you guys trading with 500 or 5,000 or 10,000 leverage, it's not doing much in terms of books. So if you guys are thinking that your account balance affects the way that you should take trades, you'd be wrong. Your account balance can never reflect the way in which we look at trades and take different trades, right? This 160,000 here holding it up, or now it's 126, means absolutely nothing, okay? So first and foremost, bankroll management. It's important to know that affects absolutely zero how much you're trading with. You could be taking $5 trades, $50 trades, $500 trades, 5,000, 50,000, 500,000. They don't matter. Maybe if you were to start leveraging like 100,000 on 100x, you would be making a dent, but that's quite a different scenario than most people are trading, right? Okay, so let's not worry about that. Let's just again, use this time to focus on proper procedure. So let's start with the basics here. We have a $500 account here right now, okay? Well, it's $532 because I took a quick little scalp trade and I made, I guess, 8% on it right before the video started, just to make sure everything was working perfectly fine here for the video, and it worked. So let's talk about the way in which we handle our bankroll. Okay, first and foremost, if I have $500 that I am playing with in my trading, now whether I'm trading altcoins or leverage trading or margin, that doesn't matter. If I have $500 here that I am playing with, okay, it means that I should have somewhere between 20 and 40 actual reloads, right? Buy-ins or reloads or whatever you want to call them. That's proper procedure. 40 is a bit much. That's kind of a standard that's used in poker because you can go on what's called random swings because poker is a game of chance. There's skill involved, of course, and there's advantages statistically. But with technical analysis, if you're making mistakes, you have to stop and just say, oh, why am I making mistakes, right? So we're going to put up an order here at 85.75, and we're going to go $50 on this order and hope that we get filled on what we want to do, right? So we're going to go, can't quite get there, $53. So we're going to go and we're going to risk 1/10 of our bankroll on this position, okay? So that would be one way in which we can do it. The other way is if we had 20 buy-ins, we could go like this and use the full amount. So here, we're going to do that. We're going to put an order up and hope we get filled. We're buying a level from the past here. And if we do, great. If we don't, that's quite okay too, right? So this is kind of the separation of what you need to know when you're talking about bankroll management, okay? You need to be able to say, okay, I've got $500 and I should be able to, in theory, if I lost $500 here, I should be able to go and put in another $500 nonstop. You should never, if your account size is only $500, you can't be trading with your entire account size, okay? You have to be able to lose trades too sometimes. It happens. It's the way in which losing trades will help us go and look at, okay, why did this trade fail? And if you're losing 1 or 2 trades and getting a good trade or two good trades, you kind of have this 50-50 ratio where you're not really moving. It means that you don't know how to handle your losses. There's a pretty interesting way that the markets and day trading as a profession works, okay? So let's just quickly look at what I'm doing here on my trade. So I'm just simply buying this whole level back here at 85.68. Maybe we'll change our order a little bit. I didn't realize it was that high. So we're actually going to set this as buy long at 85. Let's go 85. 70, 51. Sure, let's pick an arbitrary number. And we're going to say buy long, right? So our position got filled. We're going to see what happens here now with this, right? And we're going to want to sell here up at 8,600. 85.99 is where we are going to sell. And we'll see what happens. We hit our hold level and we are looking for the push up to this level here, right? So we're just going to watch this trade for a minute. Our order did get filled. $50 of profit. We could consider closing here. I think we will. I think we will close here. Okay, try to get our order closed here. And there we go. So we just did a few minutes trade, made $10. Great. So this is obviously, I would typically be holding this position a little longer, but for the purposes of this video, I do want to just take this trade, execute it, show a quick execution of a trade that you would take on a level, right? So Again, this is not a demonstration for profits. This is simply just a demonstration for, okay, this is what we would do. We would buy this level. And we can actually just set it there again. If we wanted to. So this is a way we can trade. And again, this is not meant for profits in this video. This is just to show you guys. And I don't want to get bogged down worrying about making and taking trades here and losing focus. So this is why one of the reasons I got out of the trade. Not much profits in it, but hey, it's $20 that we made or $10 or $15 or whatever it is. I think we were at $523 and now we're at $543. So we made $20 on a $500 trade, which is not bad actually. It's not great, but it's not bad. So ideally we would have liked to sell up here at this level. But again, for purposes of this video, it's not what we're doing. Getting back to it, this was quite a simple trade. We saw the hold level here. We did the knife catch on it, a few dollars over top of it. We caught it within a dollar or two. So typically you would ride that trade and you would set a stop loss and you'd be more involved in the trade and managing it and so forth. And fine, you can take your profits, but what I want to talk about is there was two ways I could have taken that trade. Okay. So I have a $500 account there. The thing is that I can risk $500 if I have a lot of experience doing this. Okay. I have a great set of conditions that I follow saying, if I'm starting to lose money or if I'm starting to make errors in my judgment, this is where I can go back and look at if I had technical flaws or if I had procedural flaws. Okay. So procedural is, let's buy a level. Let's sell here. We got too impatient. We just wanted to trade. This is procedural. Technical analysis is different. Technical analysis would have been marking this level incorrectly. So we marked our level perfectly. We bought at 8,570 cents, right? And the candle itself, 85.70. So we actually got within 1 cent of our actual trade. So right now we would have been within 1 cent and we would have been in great profits here. So that's fantastic. We would have made 30 or 40% on that trade and we would have made a few $100s. Procedurally, we had good bankroll management because we didn't want to take a haphazard trade. We have to have a reason to get into this trade, right? And technical analysis wise, we marked the correct level. We sold too early, obviously, but we don't care about that. That's the purpose of this, is to make this video, right? We sold the correct level and then we would have had our trade executed perfectly fine. So this is something that has worked in both ways. Now, we're going to get back to bankroll management for a minute here. When you are trading, the lesser experience or the lower amount of experience you have day trading, okay, the less you should be risking in your balance right here. So the balance that I have in my actual account. So right here, what you're seeing on the screen down here, this $544, you should be risking less. The technical analysis side of day trading will give you your rhyme and reason and answers. Okay. So technical analysis will tell you buy here, sell there. Again, plotting this trade, we got within what is it? 2 cents. We got within 1 cent of the perfect level because this is what we bought, 85.70.01, and it hit 85.70. So we got within 1 cent, which is, you can't get better than that. And it was 6 Bitcoin. So I pretty much bought the bottom of this move. And I would have sold here at 8,600 had I not been recording the video, right? So we actually make something about 30 points on this trade. So 30% would have been a nice trade. We made a few $100s in a few seconds. Okay. So I am doing this on this video, okay, because my technical analysis is highly refined. So this is something that you have to use the way in which your trading schedule and your trading acumen is developing over time and how you're seeing your trades go, right? If you're noticing that you make money, lose money, make money, lose money, you either have a flaw in the procedural or you have a flaw in your technical analysis, okay? So the more you're making mistakes, the less you should risk right here. Now, let's go back to the numbers for a second, okay? I have Oh, let's use a color that we can actually all see on the screen. Okay, we're going to use a nice bright yellow. So I have, and we'll delete this and redraw it. You know what? We'll use the text tool. That's even better. I have $500 in my active trading account, okay? So in my active trading account, I have $500. Like that. We're going to put this yellow so we can see. I have $500 in my active trading account. This active trading account means $500 in this balance right here, okay? So that's what that means. We have $500 in this balance right here. This isn't our total bank account. We should be backed by 20 times the amount so that if we lose this $500, right? If we lose $500, we still have a $10,000 account. So we have split the $500 positions into 20 possible losses. So we would have to actually completely disregard all technical analysis, all bankroll management. We'd have to completely disregard everything we know about day trading in order to lose that amount of money. So if you had 20 buy-ins that you lost, this will tell you a great deal of information about the way you're trading. It'll either give you the reason why you're failing technically, or it'll give you the procedural reason why you're failing. So I have, okay, so let's go back to this trade here. I have procedurally made a mistake in my trade that I took right here. Now, this is kind of done purposely for this video to show you guys what a procedural mistake is, okay? My technical analysis was correct. I bought the right level. I bought it within a cent of the actual price that it was going to hit. You know, experience dictates why I bought there and some other things, but not the focus of this lesson. This wasn't a technical flaw because I actually had the right levels, okay? So we bought here at the exact, oh, let's take that magnet tool off. It's going to disrupt our video here. So I bought here and I said I was going to sell here. This was perfect. I sold here because I was like, oh, let's just get out of the trade because I didn't want to be tied up. This would be a procedural mistake because technically we understand what we were supposed to do. We were supposed to buy here and sell here. This was very simple. Buy there, sell there. Our $520 bank account, instead of being $540, it would have been about $720 or something in and around there. Okay. It would have been much greater than, oh no, it wouldn't have been that much actually. What am I saying? It would have been around 650-ish, 650, 660, something like that. I'm just taking a quick guess on the math. And then we would have reshorted this level here to relong this level again, possibly. We would have exited our short. So we would have taken a series of trades here that made a lot of sense, okay? So this is a procedural mistake where I bought the right level, I saw the right level to sell, and I sold too soon or too late. This is a procedural mistake. So when you're talking about bankroll management, every time you get into a trade, not only are you paying fees, but you are also taking a risk. So if you are taking this kind of risk and saying, oh, I'm buying here, you have to be laser accurate on your sells, and you have to be able to say, could have actually sold this level here. You have to actually not only be accurate on your levels, but you have to also trust your technical analysis. That is a procedural mistake that a lot of people make. They are going and they are selling too quick or holding too long, not recognizing failure, not waiting for success to happen. We bought the right level to the cent. There was no reason to sell early. This was a procedural mistake. Okay. So this is procedurally something that should not have happened. What I should have done is I should have just set my sell here and just waited for it to happen and set my stop right there, right? So my losses are very limited, right? Set a stop limit order. My losses are very limited. I've procedurally done the right thing and I've made money and gotten rewarded because of it. That's the difference between procedural and technical, okay? So $500 in my account. That means that if you lose that $500, it doesn't mean your whole account is gone, okay? So if you have a $500 account, you should be trading with $25 positions, okay? And then you should be breaking those down into positions. So again, just to reiterate the first point. If I have a $500 amount in my active account, that means I should have 10,000 in my actual account, right? Which is just divided by 20, right? This is $2,500 positions. So in total, we now have $10,044. So we'd have $19,500 left, $500 in our active account. And if we were to manage to lose the entire account, then that's fine. The active account, we can just reload it with our actual account, right? There's no loss there. The benefit of this is you can't really make mistakes this way, because this right here, as you're using this slider based on how much risk. Now, it doesn't matter if you're trading this. It doesn't matter if you're trading altcoins. You could be going and trading XRP on non-leverage, or you could be going trading Bitcoin Cash or EOS or any one of these coins, or maybe something that doesn't Mana, maybe because it doesn't have leverage, right? Or maybe you're trading gold or silver, not on contracts, right? It's the same thing. This slider just is a good example of a good visual example for risk in this video, right? So in this scenario, I'm using my full $500 to take positions. And that would be something where I say, this is where I want to gauge how comfortable I am trading. So in this particular trade, I'm very comfortable with it. I'm very comfortable in the trade. So I was able to just slide up to 100% maximum, a few second trade, bang, make my money. And I grew my, if I would have left it to where I was supposed to without making a purposeful procedural error or a procedural error, I would have grown my account 25% in minutes, right? So that's a very good result. Okay. So this is a great result. This is fantastic. You've done your job properly. Technically and procedurally, you've made all the right decisions. Okay. So this is fine. If you manage to liquidate your account here, which actually should never happen, you should be out long before liquidation call. You should never just let it ride until it gets liquidated. That's a huge mistake I see people make. Even if you're $1 away from being liquidated, if you close your position before getting liquidated, you're going to save yourself a lot of money. It's just the way contracts work. If you liquidate your account, it actually takes your margin ratio and takes all your money, right? It's an important thing to know. This is the way we have to look at bankroll management. We have to take our account size, right? And if this was a $100,000 account, you would just add a 0 to your active amount too. So then instead of if this were a $100,000 account, you'd simply have a $5,000 active trading account. And the difference between active and actual account should be split into positions, because this allows for the natural growth of making an account. Quite simply, in day trading, the amount of money you can make is endless, but what can't happen, losing accounts because procedurally you don't know what to do. So this leads me to one of the most important points I can talk about with bankroll management. Okay. Let's say you make one good trade, one bad trade. And we're going to use ones and zeros for this, kind of like binary code. 1 is going to be a good trade. 0 is going to be a bad trade. Okay. So good and bad. You make a good trade. You make a bad trade. You make a good trade. You make a bad trade. You make a good trade. You make a bad trade, and so forth. 50-50. Therefore, putting you in this position of neutrality. Therefore, you make money, you lose money, you make money, you lose money. You're kind of always break even, and sometimes you edge out your profits. So you kind of start to find a way to, get bigger profits off this. This is not correct. Okay. You will make twice as much money actually limiting your losses than you will actually making good trades. So when you start to take these bad trades out, this should be everybody's main focus, is reducing the bad trades that we do. Okay. So what does that mean? That means looking at how you've been trading. Okay. Analyzing what you've been doing and looking at the mistakes you've been making and being honest with yourself. Because the thing about bankroll is it's very egotistical. Okay. Bankroll management is the thing that breaks and makes traders, because it's a battle of egotism, right? It's a battle that people have with themselves where they think they're above it, they're beyond it, right? What I see a lot of brand new traders do is they lose 40%. And then they think they can just make another 40% to equal that out. That's not the way math works. If you lose 40%, it takes a lot more than 40% to make back that money, right? Losing 40% of a trade and then trying to make 40% back is not going to equal to the same spot. So not only do you make the job on yourself harder, so when you lose trades, you actually make the work to have winning trades mean less. So you actually make your job quite a bit harder. It scales up the difficulty in growing a bankroll and starting to have a position, right? And starting to take profits out of your active account. Because if I build my active account up to $1,500, I can simply just take out money in that account, put it in my main account, and so be it. And we're going to talk a little bit about that later. But the thing that we need to master is reducing these bad trades, okay? Taking out these bad trades. You will make twice as much money in a year by having no negative trades than you will focusing on making good trades and the right decisions that lead to, oh, I just made 50%. I feel so good. It's easy to make money in markets. It's hard to not lose money in markets. That's the difference, okay? This is just human error. This is just the way we are when we make bad decisions. Emotions come into play. Procedurally, we're making mistakes. Technically, we're making mistakes, and we get in very unoptimal positions that lead to devastating results. Very, very straightforward ideology. The problem is that those bad trades, they actually equal a lot more than the good trades. Again, so the goal of bankroll management and the goal of dissecting procedurally, what are you doing? The goal of dissecting technical analysis, what are you doing? Is to start to take away these zeros, is to start to take away these bad trades. If you were to, all of a sudden, let's say this is a neutral position, okay? You took away good trade, bad trade, good trade, bad trade, good trade, bad trade, and you ended up with a straight across balance because you started with a good trade, okay? What happens if you start with a bad trade? Same exact scenario, but you've actually lowered your account balance before taking your good trade, like this. So all you've simply done is the same good trade, bad trade, good trade, bad trade. You start out with a bad trade. You're actually losing money long term because by starting out losing X amount of percentage, this good trade doesn't get you back to neutral. This good trade actually gets you to a spot where you're less than what you started with. And then this compounds and this compounds. And actually, good trade, bad trade, good trade, bad trade, good trade, bad trade, a one-in-one scenario only makes you even when you start with a good trade and then you have a bad trade and then you end up in a neutral position. The other 50% of the time, if we're just going based on the statistical numbers, like just a one-to-one, 50% of the time, if you start with a bad trade, you're actually losing money. So you're losing money even if you have a 50% ratio, right? Even if you good trade, bad trade, good trade, bad trade, you're actually losing money. So this is crazy because it's actually skewed against you to be completely neutral, to be completely random. Let's say you knew nothing about technical analysis. Things could go up or down and you just randomly pick, I think it's going to go down for no reason. You don't know what you're doing. 50-50 is actually less than 50-50. So this is not, yes, it has a 50% chance to go up or down, but you are losing more money than you're making on that 50-50 call. So it's very interesting the way it works. So if we were to even take out one of these bad trades, let's now talk about reducing the bad trades that we have. Let's say we take out this bad trade. We have good trade, bad trade, good trade, bad trade. Okay. This is also working slightly against us because if we were to use the entire balance here, again, we have good trade. Our account balance goes up quite a bit. The bad trade here, this one bad trade equals more losses. So if you made $100 here and $100 here, and equally you were to risk the same percentages, instead of losing $100 because this is 100, let's see that properly here. This is 100. This is 100, right? This would be something like 140 negative. So you see, you're still skewing yourself against making money in bankroll management sense, right? You're still getting, okay, let's make this clear. That's a 4 like this. Okay, it's a 4. It's a little sloppy, but that's a 4. You are still being skewed against losing money using the same statistical results. You see, no matter which way you look at bankroll management, you'll always lose more than you make unless you're always making money and it's compounding for you. The losses will compound again